we on? Fantastic.
I hate these couches.
First of all, thank all of you for coming here to do this. I know some of you have come a long way. Rebecca, you in particular. Why? Because you're most jet lagged. Because you've come from San Francisco. Let's start with you. Just generally, what is hot in wealth management right now? What has sort of stopped you in your tracks? What's got you thinking?
I think what's hot in wealth management right now, I think there's really two axes of this for me. And it's one is wealth management, meaning almost cash flow management, right? So, basically letting people have the power to not have to think about their finances, because most people actually don't want to spend a lot of time. So we're seeing some things right now come up in that category. On the higher end, the more affluent end, we have Empower, which is really taking that and sort of making people very smart about their money. And on the lower end, we have companies like Dave. And so really this whole idea with AI merging with fintech, that you can kind of set it and forget it and be responsible. So I think that's very interesting.
Right. What was the name of the last one, did you say?
Dave, JP Morgan just led an investment in Dave.
Right,
and there are three or four others in that category, and we're watching that pretty closely. And the other axis is really on insurance and InsurTech. Was that a vehicle also for wealth and wealth management?
Okay. What about you, Josh? HSBC has a VC arm, correct?
HSBC does have a VC arm, and we have quite a lot of investment going on actually in the business as usual. By far, for me, the most exciting thing is engaging a broader set of customers. So for 20 years, I've talked about what I call the Bloomberg problem. Everyone creates a service, but unless you're sort of a real expert in how it works, you don't know how to use it. And then the further feature development gets even more sophisticated to a smaller group. And what we're now seeing is a huge number of services, whether it's the robo sort of advice we're doing, whether it's, we'll talk about eToro, whether it's some of the alternative assets that start to engage people who traditionally would only have ever put their money in a deposit account or put it into some basic bonds and shares.
And that's super interesting, because that's exactly like when we talk about Dave and Empower and even the robos, right? It's, the financial inclusion issue, and financial services were really designed toward people who would spend a lot of time understanding that space. And now we're seeing all these services really designed to go sort of downstream and more mass market and help give more access to people.
Great. Is this a generational thing, Ronen? Is wealth management fintech companies like yours, are they drawing in, I would imagine, younger people with less money? I mean, when I think of wealth management, traditionally, legacy brands, old people, retirement, that kind of thing. This is not at all what you do, is it?
Well, definitely, I would say that for us, the sweet spot, the target audience is somewhere around 25 to 35, which would be very different than your usual wealth management typical client. And what we see in that segment is people who are really want to be much more engaged with the product experience. So they're not just letting someone else take their decisions for them. And they're looking for a platform that would do that with as little human interaction as possible. So most people would like to make their own decisions.
As little human interaction as possible.
Yeah, in terms of not speaking to someone on the phone, going to a meeting, filling up paperwork, being more of an online experience.
Okay. So this is where the whole area of robo-advising comes in. I'm under the vague impression, though, that pure robo-advising has suddenly become not quite so trendy, that people do want a hybrid model where there's some human customer service available. Yes, no?
Yeah, I think that's true. I think that's true. I mean, I will say, even when I was in Future Advisor, which is since sold to BlackRock, but when I was there, it was really interesting. I mean, people would do the initial interaction with the company oftentimes, but oftentimes it took a call, right, just to close them. And it wasn't a long call, but it was just, I want to touch you. And I know that there is this tendency where we all think nobody wants to talk to anybody, but I will say in situations like wealth management and insurance, I have personally seen the marketing numbers showing that not a high touch, but a small touch will actually generate a much more significant closure rate and actually retention rate for those customers. And so I think people throw the baby out with the bathwater in terms of no touch, but I think there is just like one step back from that really can work well.
I think there's one other aspect, though, we shouldn't underestimate. I mean, one of the things that we use internally is we're saying it's moving from people supported by technology to technology supported by people. So it's really important that you do have an experience that works for customers, that end-to-end, if they don't want the interaction, it's there. What it actually does is it changes the nature of what the people are doing. So before HSBC I was at Google Google started off as a self-serve business. It now has a very large business, but effectively sales organization to help customers get the most of it. And I think that's the direction of travel, but it will definitely have a benefit to have some people who can support that, whether they're in contact centers or in branches.
You, Josh, actually said to me earlier that wealth management fintech apps are a product, not a business, and that those products do not on their own create sustainable relationships. Is that where there's still some role for humans in banking?
I personally think there's going to be an ongoing role for certain types of advisors, particularly with high net worth people, for example, who are looking at alternative assets. We sometimes compare people investing in cryptocurrencies as people might invest in classic cars, they might invest in art. It's different to your broader portfolio, but it potentially has a role. So people looking at that. But the mainstream, I mean, we're on this panel, AI, digital engagement methods, helping customers with decision support, personal digital assistance, the bulk of the market is going to go in that direction.
Okay. In terms of retail investors, just ordinary people on the street, people sitting at home in front of their laptops, should they really be getting into crypto, Ronen? I know you're going to say yes, but
Well, I wouldn't say, that you have to put all of your life savings into crypto. That wouldn't be very wise. But you see the retail segment of the market is really keen on getting a piece of the action. And I think, what you would usually allocate as the part to the more risky investment, I would definitely say that would be more fitted towards cryptocurrency. We on eToro, we offer a crypto copy fund, which it gives you with a click of a button access to the top traded cryptocurrencies, and we see that as a product that's well suited for that typical risk factor.
okay. Now you're offering products that allow people to short cryptocurrencies and CFD-style derivatives. Now, as a layperson, I look at these and I think, wow, that is dangerous. I would not do that with my money. Why is this okay?
So first of all, the platform is very transparent. So you see, you have all of the information you need as an investor on the platform. And we do offer, ETFs, the actual equities, and non-leveraged products as well. So it's a wide array of offering we have. And for each client, we try to tailor fit the experience. So we do a whole KYC process where you fill a lot of questions about yourself, and then we can better understand what's your risk profile and really custom fit the product experience to what it is that we think is best for you.
Okay. Is this the kind of area that might invite regulation? When you look at the whole wealth management fintech area, are there any areas of it or companies that you see where you think, oh boy, there's a real risk that government might step in and put some guidelines around this?
Yeah, I mean, I think it's unquestionable that ICOs will start being regulated. And it's funny because you always hear, oh, it's different now. But I was in Lending Club in the really early days, and then it was different also, right? And that was, disintermediation of banking, peer-to-peer. We're going to cut out the middlemen. And it's the same script, but just, 10 years later.
Are people in ICOs literally saying it's different this time?
Yes. But it will be regulated. And I think regulation is necessary to make it a big industry and to make it legitimate, and I think that's coming. And so I think that will happen. And I think where I worry more is when people are allowed to take loans out on their portfolio and kind of double and triple down. And during
leverage.
that, and that's happening, right, on some of the ICOs. And so that really worries me because I was in San Francisco. I'm going to date myself, but back in the first .com and like the late 90s, early 2000s, and you saw people lose a lot. And there were people that bankers were very willing to come and do margin loans for them. And so I think it's different gambling with what you have versus what you're borrowing. And so my advice on Bitcoin is I own Bitcoin. And I wouldn't tell people not to, but take the money you would have. The retail investors go to Vegas, right? Take the money you would have taken going to Vegas and put it in Bitcoin. So.
I'd go further. I think we want this to be regulated in the right way, in the sense of there is a reason that lots of these regulations exist. People unfettered will borrow more. A lot of people will borrow more on a credit card they can afford to pay back. They'll take out mortgages that they can't afford, and certainly I think peer pressure can cause people, especially at the end of a bull run, to make investment decisions, which isn't about it means I can't go on vacation next year. It means I don't have a retirement. So I think
It means I don't have a house.
They don't have a house.
I don't have a
We
house.
have-
I've seen that happen to people.
so how the regulation works is a much more complicated question. But the fact
Yeah.
that there needs to be some regulation, I think, is certainly something that I would support.
Well, and it adds legitimacy, right? The regulation, there's too much, but there is regulation that just adds legitimacy and makes it a category that can grow.
Right, right. The thing that I'm also of a certain age, so I remember the 99-2000 bubble as well, and the aspects of it that feels very familiar to me is that you have a sector in which asset prices are rising, but the underlying asset itself produces no revenue. We saw this in 2000, and it did not end happily, although we do have a nice big conference out of it. Go on.
Actually, Jim, on that, I think there is one very interesting question. By the way, if anyone here has an answer, please come and find me later to this question, which is, I think there's a lot of use of machine learning, AI, around some of the investment, the portfolio side.
Yeah.
The application of that to inherently uncertain discontinuities, and at what point you trade that off, is a much more complicated area, and that's something that we are
right.
looking to find
how you model
solutions.
the black swan event, or how you model, and if you don't have the data set, you can't
if you
model
haven't
it,
trained
right?
the data, or if you train the data, you given train the data with some of these events in the past. I mean, it's the micro version of macroeconomic forecasting.
I think you should do that with the press stories, right? I think if you just used all that data for the press stories and figured out when the cycle was the hot, I think that would be very interesting.
I think, AI and machine learning, that, in terms of wealth management specifically, that seems like the one area where it's best applied, where, I can't see a downside to it.
But
having software examine your portfolio and identify opportunity and risk, this seems like an obviously good idea.
But to believe that, though, you would have to believe what we're all told is not true, which the past is a predictor of the future, right?
Yeah, I suppose so.
I think, well, it comes back
I
to the people
have to
side.
believe something, Rebecca.
Right now, we can't see a better solution that says absolutely apply the machine learning, put your training data in, but you want somebody who's had a long history of watching the world with a panic button to say, okay, these predictions, these data look a bit concerning now. And if there's a technology solution to that, that would be great, but I haven't seen one yet.
Okay. Another change I've noticed is that a lot of fintech companies start out as these sort of like sexy retail-oriented consumer plays, and then as time goes by, they morph and they form partnerships with legacy brands, and they end up running a successful B2B enterprise business, basically, somewhere on the back end. Are we at the end of the era of sexy consumer fintech plays? Ronen.
Definitely not. We're all about being a sexy brand for the retail segment of the market, so we're not at all into B2B, although we do have B2B partners. We see, in the ecosystem, the perfect fit for us would be where we bring the product experience, and let's say a banking partner would bring the more of the traditional banking infrastructure, so you would keep your client funds with a traditional bank, but we would be the product experience. But we definitely aim to be the retail brand. So I think, if anything, retail brands in the fintech space will just grow stronger rather than going back to the becoming small B2B plays for banks.
Okay. What do you see, Rebecca? You must get these pitches all the time.
I actually think, I'm going to take the opposite tact. I actually think that it's really hard and expensive for a fintech company to go directly out to customers. And most of the ones that we see, you guys have done an amazing job. Most of what we see, though, are people that started out on the direct-to-consumer space, and that customer acquisition cost is very high. But then after they prove out their model, they then work with a partner, right? And they work with a partner going forward, and that was kind of the path of a future advisor, as well as Blend. Blend was shocking, right? So there are two things happening. One is the customer acquisition cost issue. Two is that 5 years ago, I would not have ever told you that somebody like a Wells Fargo would work with a small company and let them have the whole front-end funnel. There were other companies at that time which were really good, like Oflows, that had the whole front end really automated and beautiful, and banks just wouldn't work with them. But I think two things are happening. I think fintech companies, the customer acquisition cost is high. For banks, I think they have so much on the back end and so much of the regulatory stuff they have to just deal with, that they're really happy to let another company that they partner closely with handle what they're good at and handle that front-end UI. And that's different. That has completely changed in the last 3 to 5 years.
But don't you think
Is
there's
this
a
what
risk?
you? Can I bring Josh in here? Because you're in the position
You're
of being
in.
at one of these old legacy brands that presumably at one point was afraid of being disrupted. And I'm guessing right now you're feeling slightly more comfortable about the whole thing.
Yeah, I think at HSBC we've got a very different attitude to this than we would have done 3 or 4 years ago. One is that we don't think every group of customers, even in a market, is going to have the same experience. So we're very relaxed now about saying we may have a default approach, but we could have a different front end from a fintech or a different service, and it may operate in different markets. The second thing I'd say is we're much better at actually enabling that. We and other banks, the investment in APIs, in services, in how we've done that, means even previously had wanted to make those partnerships work, it was so difficult and expensive to do it, we would have really struggled to deliver it.
Okay. So this makes me think that we're not, in terms of exits, in terms of fintech companies starting, getting funding, where are the exits? Are they just going to be acquired by larger traditional financial institutions, or are there still IPOs to be had? Or
I think if I may represent the fintech brands or wannabe brands out there, I would say that as a founder, when you start up a company, you really have this huge audacious goal in your mind, and you start pardon me for the cliche, but you want to make a dent in the universe and not being just a feature for a big bank.
Right.
And what I think, from my perspective, is that most of these B2B plays will end up being just very small features for a big bank. And that's not something that I think for most founders is very interesting. And I'm not sure it's from a venture perspective also very interesting. So I would say that's the big challenge, being in a B2B play with that specific strategy.
So we hope so, because there'll be clearly some of these businesses, and eToro may be one, that make it to that customer brand, but there'll be a lot that don't. We mentioned the cost of customer acquisition. And if there's some great technology and services, we're hoping that we're going to pick some of that up at a very good price.
And I totally believe there's room for more IPOs here. I think there are people building really great companies that can go the distance. And it's about being incredibly strategic at each step of the way and making sure you're laying the groundwork for that to happen. And I think you guys will pay a really handsome price for a lot of these companies. So thank you.
are these big IPOs in the future, are they coming from like really amazing, fresh new ideas? Or are they simply providing existing services but cheaper, like taking costs out, sort of what we talked about earlier, where they're outdoing Vanguard in terms of taking management costs out of the whole thing?
So I don't think we'd ever invest on anything just on a cost basis, right? There has to be something fundamentally different. And I think a lot of it's quite nuanced. It's understanding your market. I mean, I think eToro, I was just talking to you earlier, an amazing job of really understanding like product market fit and what consumers wanted today. And we're seeing that. I mean, Robinhood is a great example also, right?
Yeah.
Of, a lot of people had written off the whole sort of, frequent trading kind of thing, and they figured out a whole new way to do it. And so, Robinhood and tapping into that, tapping into sort of the millennial, desire, that company has just taken off. And it's because they got the product market fit right. And they did a really good job of executing on that. And yes, there are exogenous things that also happen, but I think really keeping in mind, like, why now? Why are things different now? Why with the mobile phone? Why with millennials? Why with the feeling or the trust or lack thereof of the banking institutions? Like, why now? And then really understanding, like, what's going to resonate with your consumers and getting that just right. I mean, that's gold, right?
The one thing I'd add, though, is it's not going to be like the first .com boom where if you create a customer experience, the theory was you advertise it you monetize it with advertising, it consolidates. There's going to be many fewer survivors. I mean, there's going to be a lot of investment train wrecks.
Many fewer
survivors. So there will be some
okay.
people come through, but the curve, I think, is going to be very different. There's going to be much smaller fintech survivors that make it through that gap compared to what some of the investment community might be expecting.
But it is amazing. We were seeing new things like people monetizing with tips, right? You do a service and you're like, can you tip me for that? And it's working. And then they're paying more than, they pay your ATM fees, right? So it's not more onerous than that. And so I think you all have set up a really interesting structure where the ATM fees have gotten so high, the bounce check fees have gotten so high. There's so much room underneath that just for people to voluntarily pay you because you're like, wow, this is a deal, right? So you've created so much room underneath there now that they don't have to monetize with advertising anymore. So it's good.
Yeah. The other thing that strikes me about today, and perhaps Ronen, we can end with you on this, is that earlier in this panel I sort of made fun of ICOs a bit because it does really feel like it's a bubble. But the one thing we learned from the 2000 dot-com bubble was that businesses survived, and in fact, out of the wreckage, within a very few number of years, some enormously profitable businesses emerged, and this entire conference is based on that, and we're all employed in these businesses, and we could not have got here had we not gone through that crash. So I do wonder if in the future, sort of 10, 15 years from now, there'll be a series of like really solid ICO-based companies.
I think it reminds me, I just saw this cartoon of the Amazon stock since 2000, and on each year, there's a big shot analyst saying, Amazon isn't going to do well, so, and it just keeps climbing and climbing.
Because it will never make a profit.
Exactly. Everybody's written off Amazon in 2000, then again in 2007, and then again. So I think if you look at the ICO as an investment vehicle for newly set startups, that's the basic idea that has to be more formed and possibly regulated. And we will see very interesting stuff and technology coming out of that space. But of course, all of the negative buzz that's going on right now doesn't really help. But for sure, some of these companies are going to create sustainable, groundbreaking technology for decentralized applications.
Yeah. Okay, so what should we look for in the future? I have to wrap this up very quickly. We've only got a few seconds left. So I shall start with you, Josh, at the end. What should we look for? What should we look for in the future? What's going to be exciting? What's hot? What's on your mind right now?
By far, again, come back to where we started. The number one thing is engaging a broad mass of consumers, but investors who would have left money in a deposit account and starting to experiment in new ways of behaviors, how they manage that money, and which one of those start to scale up.
Rebecca?
Yeah, and I'm going to give you, I'm kind of following on that, just access, right? I mean, ICOs, what they offer is, in crowdfunding and all these things that have happened, are just more access in a broader way for people to choose where to spend their money. And I'm a little cynical. I think at the end of the day, I mean, ICOs are not different than IPOs. You hire a book runner, somebody markets it for you, and I think bankers will end up owning it all again. It'll just come full circle. But I do think it's going to be broader access to many different kinds of financial instruments and the diversity of that. And I think there will be a lot of services out there that help people understand what their options might be.
Okay, very quickly, Ronen.
I think it's going to be more and more about really custom, tailor-fit experiences that speak with your own kind of tone of voice and cater to a much broader part of the population in terms of financial services.
All right. Thank you very much. I do appreciate it. We are out of time, and thank you.